the biggest challenge most people have when they're starting out is track record, right? Because you're an unproven entity, and no one wants to, risk their money on be the guinea pig, and if it goes well, then that's great. But if it doesn't go well,
welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
All right, we are back with the Fully Funded Show, this time with a friend of mine, Ben Fraser. I've known Ben for a few years now, and both him, his dad, and his firm are really ingrained in the world of syndication and funds. So I'll turn it over to Ben to give himself an introduction instead. But yeah, really excited to have you on today.
Yeah, thanks for bringing me on, man. It's really fun, and appreciate it. And my background, I'm the chief investment officer at Aspen Funds, and I've kind of been in, like you said, the syndication fund space, coming up about 7 years now. And actually came from banking background, so I was a commercial banker, an underwriter for kind of my previous career, and kind of made the switch into private equity. Saw a huge opportunity just in raising capital from retail investors, but really had no idea what I was doing when I moved over about 7 years ago. Thought it'd be a lot easier than it was, and kind of made every mistake in the book, but I figured a few things out along the way. And we've got a great team. We're kind of a vertically integrated operator, so we raise capital for a lot of our own deals. We work with a lot of fund managers and retail investors, small family offices, and we've since raised about $200 million in equity. Most of that's all from accredited investors, and it's been a fun ride so far.
Yeah, and there are a few things I kind of want to dive into as relates to your business and Aspen Funds. I think one, business aside, like what's it like working kind of with family in that business as well? I know it's you and your dad who are really heavily involved there. Like, what's that dynamic like? What's the experience like? I think a lot of people who may be listening to this, whether they're a husband and wife or father and son or family members kind of working together or just friends partnering together, like how do you guys balance the relationship piece of it with the actual business side of it as well?
Yeah, we could probably have a whole podcast just on that topic because there's a lot of nuance there. But when I decided to jump over, it was a pretty big concern to me, to be honest. I was a little bit nervous. I'm the oldest, and my dad's very hard-headed. I'm pretty hard-headed. Growing up, we had a lot of friction. Probably like a lot of people, but it really caused me to ask a lot of the questions up front, like, hey, how are we going to, if we have a disagreement, is that going to bleed over into business? Or, are you going to give me the leeway to go make decisions that I need to go make? And so it kind of forced a lot of good conversations to have on the front end to potentially avoid some of the pitfalls. And it's funny because I talked to a lot of people that had experience working with family before I made the jump, because I was trying to get as much data as possible, right? And it was usually very polarized. It was either, it was terrible, it was the worst thing ever, we all fell apart and the partnership blew up and our family's never been the same since. Or it was, oh man, it was the best thing ever. It was, I wish I could go back. My father's now passed on and I wish I could still have that. So it was kind of interesting to see. It was no middle ground from at least my conversations. And to me, it really came down to being able to have openness in conversation and communication and being able to challenge things with a kind of meritocracy mindset versus a familial, nepotism things that can naturally play in. And so I think both my father and I are pretty rational people, pretty heavy right brain, very high T on the Myers-Briggs. And so it was kind of natural for us to, hey, the best idea wins. And we're going to give space and a place for each of us to be in our power alleys. So it's worked out well. And to be honest, the other kind of helpful thing too is we have two other partners. So I'm one of four partners, my father being one of them. And that's actually helped a lot, right? Because when there's disagreements between us, we're not the only ones having to work it out, and also just brings in other perspectives that, maybe he and I think too similarly like in certain areas that can have more balance. So overall, it's honestly been amazing. I love it. And I do think, especially people now, like, I think there's a lot of benefit to working with people that have gray hairs. And a lot of the reason I've had a lot of success is because if you go to my website, I'm the youngest partner by 20 years, and I get to leverage the experience and expertise and all the scars and mistakes as well of people that are 20 years ahead of me, and hopefully can avoid the same ones, but also get the credibility that they've built. So yeah, it's been good. It's been good. And, I definitely encourage people, to think if you can stomach it and work out the nuances and the challenges, it's been a huge bonus for me.
Yeah, no, just something I wanted to definitely cover. As from the outside looking in, you both have a very, very quality reputation in this space as well in terms of you and the company. So whether you're looking at partnering with family or just partnering with someone in general, like, ask those hard questions ahead of time, as the divorces can be very, very messy, right? So making sure you get ahead of those things, I think, can set yourself up really well. But yeah, I also think too, when looking at the partnership piece of it, is whether you are an allocator is looking to do their first deals and you are kind of going into the phase of who can I go work with, right? Leveraging someone else's experience is a huge, huge, huge benefit. On your end, and you mentioned you work with a lot of fund managers, right? How have you really helped some of these fund managers coming in work with you all, leverage your experience that your firm has in operating or picking the right deals to really help them get off the ground as well?
Yeah, you're exactly right. And that the same concept can be applied in so many ways, right? Leveraging partnerships and leveraging experience in so many different ways. And so because Aspen Funds, we've got a 11-year track record now operating in different verticals, we have a great reputation, and we work very hard to continue to build that and do the right thing by our investors. And just the longer you're in the space, right, the easier it is to just keep operating and to raise money. And so it's a great place for people that are wanting to get into real estate. They want to get into the capital raising business, and they realize, you know what, I like the capital raising side of it. I'm good with people. I'm good at the sales side. I want to raise money as a core part of what I do. It's a really great model to partner with experienced operators, because you get to leverage their expertise. You get to leverage their track record to your benefit. And the biggest challenge most people have when they're starting out is track record, right? Because you're an unproven entity, and no one wants to, risk their money on be the guinea pig. And if it goes well, then that's great. But if it doesn't go well, they don't want to be the ones to be the test case. So it's a great way for people getting started in the space to partner up and leverage the experience and expertise of experienced groups.
Yeah, and also another side of that too is that one, you can go borrow their experience, but we commonly see people who are operators focus in maybe one or two verticals, right? And you can go, say you want to go operate multifamily in Texas, and you're buying apartment complexes there, but your investor base wants offerings in other areas, right? We've seen a lot of people go partner accordingly to go build diversity to your portfolio. So on your end, how have you leveraged diversity to really be an advantage? I just know you are in a handful of different types of verticals. We were talking prior as well, going into a new one here soon too, which sounds really promising. So on your end, kind of how are you thinking about how you construct your portfolio and bring diversity to your investors and partners?
Yeah. I mean, my perspective is partnerships can be the fuel for a lot of growth, but the flip side of that is if you get in the wrong partnerships, it creates usually way more headaches than it was worth. And so it's really, really important to pick good partners. But if you pick the right partners, it can accelerate everything you do. And so not only do we partner with operator or fund managers that want to work with an operator like us, in certain verticals where we don't have the deep expertise, we'll actually partner with other very experienced operators. So the best example is our oil and gas fund. So oil and gas, it's a very, very different asset class, very, very different than real estate. A lot of nuance, a lot of technical considerations, a lot of needing to understand geology. And to really do it well, you need to have a long time in the space because it's a very cyclical asset class. It's very sensitive to commodity prices. So you expose yourself to other risks. We're smart enough to realize we're not the experts in it, but what we did do is we spent several years kind of building a relationship with a firm that was not experienced in raising capital, but they had 40 years of experience in this space of managing funds, operating assets, and incredible track record. And we're able to kind of bring our expertise as fund managers, structure, strategy on how to build the portfolio, and then really expanding the reach to a broader retail audience because they only really raise money from family offices and not from retail. And so we were able to expand the reach. We became co-general partners with them, but really let the kind of decision making on the assets, though we have certain rights, but they're the lead on the acquisition strategy, finding the deals, operating the assets, et cetera. So, it kind of goes both ways, leveraging the partnerships. And then the other verticals we're in, we've been investing in debt and credit type products for over 10 years. That's where we started. And so, our new credit fund, which we're about to launch, it is a core expertise of ours already. We've been doing mostly in residential for 11 years. For the past 3 years, we've been doing a lot of commercial just because that's where the opportunity is. And so we're just rolling that out into a new fund with some more flexible products for our borrowers. And then we also do development of industrial projects, which one of our partners has been doing that for a long time. And so he kind of just brought that in-house, and we're vertically integrated there, lead developer, and have great track record there as well. So those are kind of our three main verticals. And then we'll do kind of one-off things when it makes sense. But those are the three that we're really focused on.
Yeah, and that's a big piece of it too, is giving investors diversity. Like the way I think about this is if your investor has $1 to go invest and you offer them the same offering over and over again, you may get 25, 30 cents from them. But I think if you can give them diversity in terms of hold time, in terms of asset class, in terms of the yield you get, depreciation, right? You can go capture a lot more of their investable assets to go allocate. So yeah.
Yeah, I 100% agree. I think a lot of people, they lock themselves back themselves into a corner because they're only doing one asset class, right? And if you're an allocator, if you're helping people deploy capital into these alternative assets, the best thing you can do is have options, right? Because as you and I know, there's investors that at a different stage of life that just want income, right? They just sold a business and they need to replace their income with a big pile of cash that they have, or a big pile of cash with more income. There's other people that are younger that they don't need the income. They have other sources of income and they want to just grow the net worth. They're two very, very different investor types that need very different types of investments. And having something that's going to suit a lot of types of investors is one, going to help you raise more from the same set of investors, but also attract different types of investors for the different types of products you have. And we've seen that, in spades, where our average investment per investor has continued to climb every single year, right? So we're increasing the number of investors that we're bringing into our LP base every year, but we're also increasing the average investment of all those investors. So we're getting this kind of multiplicative effect of not only new investors with new capital, but the same growing investor base investing more with us, which just makes that number we're raising even higher over time.
Let's talk about how you grew your investor base in the first place, right? So what does that look like for you in terms of, you can kind of break it down into categories, right? One being the retail investor base, two being the kind of fund manager and or capital partner investor base, and three being more of the family office or larger institutional side checks. So on your end, like how do you work on growing each of those three, and feel free to add if missing any kind of categories there too, like types of investor that you all have?
Yeah, no, it's a great question. I mean, we started mostly with the retail. And so when I joined 7 years ago, we only had $10 million of assets. And in our space, it was all equity. So $10 million of equity, $10 million of assets. We've since the past 7 years have grown to $500 million in assets, $200 million in equity. And it's just been, step by step. There's been these kind of inflection points, but it's just as you continue to do the right things over a long period of time, it just compounds, right? In our business, like compounding only works in the investment side of things, but definitely on the capital raising and just building the assets that you're doing. It gets easier and easier and easier. But we started out like most people with friends and family. And so before I joined, they raised about $10 million just really from their networks. And so when I started, they had no website, they had no marketing material. They had a really bad pitch deck. And the first year, they're like, yeah, go raise this another $10 million. So they raised $10 million in 5 years, and they wanted me to go raise another $10 million in 1 year. And in my mind, I was like, that can't be that hard. But definitely learned the hard way. I got to about like 8.5 million, so I was close, but still didn't quite hit it. And my approach was just, one, leverage the investors and the network that we already had. And so there's the easiest money you'll ever raise is from people that already know, like, and trust you, right? And people, either whether they're current investors or they're just people that have known you from other things for a long period of time. That's the first place you always got to start. The next is second degree connections, where you're then getting referrals. You're getting people to introduce you to other people that may be interested in leveraging through your network to get warm referrals for new leads. And then the third is probably where a lot of people don't know where to take that next step, is that third degree connection of how do you attract people to you that don't know you already, and warm them up, engage them, build trust to where they actually write you a check. And that took me a long time to figure out, just because when I was doing it, there weren't a lot of people that were doing what I was doing. And so I was just trying to figure things out and learn the hard way. But it's like most things, if you position yourself as an expert or an authority in a particular area, where people see you as having some insights that are valuable, it's a naturally attractive, a natural pull for investors. And so just human psychology, and you're the expert sales guy, so I'm preaching to the choir here, but the way that psychology of people works is, if they perceive you as being an authority in something, you're way more likely to have people come to you than having to go beg, right? So if you can go and flip the script where all of a sudden people are coming to you because you're the expert, it gets so much easier. And so that was kind of a big shift for me, is how do we position ourselves as experts in certain areas? And the people that are, the top 5% raising capital and the top experts in their niche, they're the ones that are getting 80% of all the capital, right? So you got to figure out, how can I go and position myself to be in the top in some area, because all the capital, majority of the capital, flows to a small amount at the top. Not to say it's you can't make it there over time, but that's a framework that I think is really helpful to flip the script on. And then from there, I mean, we continue to raise money from retail investors, from accredited investors. It's a core part of our capital base, will always be a core part. But we started working with fund managers and, giving up some of our back end to, bring other people in to just increase the overall pool of capital we can go and invest with, right? Because it's in that scenario, everybody wins, right? When you have more capital available, you can generally negotiate better deals. You get access to things that maybe you couldn't have before, and everyone kind of win that scenario. And then the family office, institutional money, that's something that we started the path down probably 5 years ago, but had a couple, I wouldn't say negative experiences. They were just very vulture type investors and lenders. And so it was it kind of put a bad taste in our mouth. And that was right. We started seeing some inflection point at the retail. So we kind of took a pause on some of that, but have since started building relationships with, some small family offices and some small institutional investors. And when you get a couple of these relationships, what's so interesting about these groups, at least what we're seeing so far, is it takes a long time to build the relationship. It takes a long time to get your foot in the door and to get that first check. But they're just like everybody else. It's really driven by relationship. And so they want to see, do you pass the initial checklist of due diligence on, do you have a decent track record? Are you not a criminal? Do you have a good strategy? Do you have a unique competitive advantage? If you kind of start checking some of these basic check boxes, then it's purely relational. And, once they find someone they want to work with, they want to just keep doing more with these people. And so you only need a handful of these relationships. And so we have like 3 or 4 right now that we're working with us in different things. And it's a lot easier to raise money from them now than it was for that first time. And they're writing big checks. And so it can be a really big amplifier to whatever you're doing is to have and start building and nurturing those relationships. But it could take some time to build those. And it's, a lot of people try and go to the conferences and just go try and meet them, but it's difficult. You gotta work through your network. You got to get introductions. It's like a lot of things. It's a numbers game, and to find the right one, it could be hard. But once you do, then it's, game over, because it's a big shift in ability to bring the capital that you need.
So yeah, all super helpful. And I think a big point you made there too is the shift of positioning yourself as an authority or an expert in a conversation between the podcast, the educational content that you all share, the newsletters that you do. I think for you, those conversations shift. I'm sure you have calls now where people are like, oh, you're Ben, or oh, you're Mike, right? In terms of knowing the team that they're speaking to, right? So it's a whole power dynamic shift of, it goes from much more of a push to a pull, right? But I also think it's important too for people to note that for it to become a pull, you got to push a lot in the beginning to go do it, where if you don't do that, it's not going to come towards you at all anyway. So I think that's something that people miss at times. They may go see a more finished product, or a product that's much, more shaped when looking at a firm like yours and saying, hey, this is, they're lucky, they have all this done for them already, right? It's much easier for them to go raise capital. I think people really miss those earlier years of the work and groundwork you put into place of doing the right things over and over and over again for a period of time, that now it becomes significantly easier to go raise that $5 million raise, $10 million raise, $25 million fund, right, than it was in previous times.
100%. I'm so glad you made that point, because you're exactly right. And I was in the same boat where, 6-7 years ago, I was looking at some of these bigger sponsors and folks that raised a lot of money. And I'm like, man, how did they get there? Like that, it's all working for them, and everything they do just, they're raising so much money, and it felt impossible. It really did, because it felt like I don't know how to get there. And I was doing all the things of mostly push activities where it was, we're doing these like cold call dinners, we're doing Facebook ads, we're doing anything I could think of just to get in front of people that had money. But it was a mindset shift, partly of like one of the books that I read early on that really helped was Pitch Anything, Oren Klaff, right? And he has a few things that some is a little bit weird to me, but some of it's actually very helpful of, pricing, of where I actually viewed what we're doing as the price, right? What we're offering to investors, if they invest with us, it's a privilege for them to get to work with us, because we're really good operators. We're going to do the right things, and we really take care of our investors, right? And it's a little bit, initially it's kind of a false confidence thing of like, I gotta I really do believe that. But the more I've seen other bad operators in this space, the more I really believe, like, if you come into the Aspen ecosystem, like, you're going to like it, and we're going to do everything we can to make it awesome for you. And that shifts the conversation, because now I'm not desperate, right? I think what I struggled with early on was this scarcity mindset of anytime I had a potential investor on the phone, I would just do everything I could to just try and close them right there, because I didn't know the next chance I was going to get to try and bring some money in. But that's like the exact opposite, right? When you're this kind of forceful, desperate, commission breath type personality, it's repelling to capital. And when it kind of shifted to, hey, I think I forget the numbers now. Back then there was like 8 or 9 million accredited investors just in the US. I'm like, I only need like 1,000 to be like one of the top fund managers in the country in our space. Like, that's not that many relative to how many there are out there. So I'm just going to go with that abundance mindset. And hey, there's also enough for me. There's enough for Sam. There's enough for all my other buddies that are in the space for us all to win. And no one's stepping on each other's toes. Like, there's so much capital out there. And that shift for me was really, really powerful, because those two mindset shifts shifted how those conversations were going. And then we're also started doing a lot more content. We're doing a lot more speaking. We're doing a lot more being on other people's podcasts. We're doing a lot more articles, trying to rank in Google, doing a lot more kind of Facebook activity. So we haven't stopped any of the push activities, to your point. We continue to run a ton on Facebook, run a ton on Google, do a lot of speaking, do a lot of like I'm doing this podcast with you today, right? Of trying to get out there and build our audience. But we're also doing the other things that are building that trust. We're trying to be everywhere, and we're producing our own content so that when you hear about us for the first time, there's already a base level of like, oh, I think I've heard of these guys before, or I heard about this podcast, and it just automatically reduces that trust time frame and shortens that trust curve to where they're more willing to work with us faster. And that's the goal, right? Is shorten that trust curve.
So if you didn't say it before, I was actually about to start Googling it, how many accredited investors there are in the US, and it's nuts, right? You don't need that many to go have a really quality business in terms of doing deals, especially if you do right by them in terms of cycling their capital going forward, right? Because if you look at a lot of the deals we do in this space, I'd say they average between 3 and 7 years, give or take, depending on the type of deal and structure. And if you look at getting someone, depending how old they are, how long their time horizon is, you can go cycle their capital a handful of times at times, right? So that one investor can compound in a big way. And it's the mindset too, that there's enough out there for both me and for other people as well. And your mindset shifts in that sense too. When kind of looking at the content piece too, you made a great point. How do you think about content? Because I think there's two sides of it, right? One is the content that helps you create net new investors. The second is content that actually helps you progress someone down the funnel, right? When they, say you had an initial call, or Mike had initial call, someone on your team did, with a potential new investor. And like, yeah, we know Aspen Funds, like we'll think about it. If something comes up in the future, we'll let you guys know. How do you guys think about content in that sense too, that actually helps progress them from, hey, I talked to Aspen Funds, they seem like decent people, but I'm not there yet, versus content or material that you use to actually get net new people? So I kind of look at those two sides of it, as net new and progression.
Yeah, absolutely. Yeah. So a lot of people think of content as the net new, right? And if you don't have new people you're getting in front of, then the progression doesn't matter anyway, right? So you have to have the top of funnel working. I think a lot of people just, it's kind of nurture all my investors, but how many people do you have on your email list? Like 20. Well, you got to go get more people in your list, right? And you got to go, build that top of funnel before you can think about the mid part of the funnel. So I want to make that caveat because it's very, very important to do the net new. But the progression is so important, because if you think about the average sales cycle for an accredited investor, they didn't know you before, to actually investing with you. For me, if someone is doing a lot of content, it can sometimes still be several years, right? I mean, it's not usually really quick. Sometimes we just time it perfect. Someone sees that Facebook ad, they just got a payoff of a deal. They love this market, this asset class. I show up at the right time. They write me a check a couple weeks later. Like that does happen. But it's very, very rare, because it's all the stars aligned in that scenario. And so you got to understand, if the average sales cycle, my guess is probably 6 to 12 months, depending on how good your progression content, or mid-funnel content is what I call it, is. So if I can shorten that time frame from 24 months to 12 months, or 12 months to 6 months, the velocity of capital that comes in the door for me is double or quadruple in that scenario, right? And so that is as powerful or more of an activity than just the top of funnel content. And so I want to spend a lot of time getting people down the funnel as fast as possible, because shortening that sales cycle is very, very powerful. So what we do for that, what I kind of view my podcast that I run as my primary content engine for mid-funnel progressive type of content. And our podcast is called Invest Like a Billionaire. It's purely focused on LPs. So it's passive investor education. We run ads to the podcast and people discover us through the podcast. But what most of the time happens is, and we track all this through our back end system. And our investor relations team is they're always asking. The only question I say they have to ask every single time is, how'd you hear about us? How'd you hear about us? How'd you hear about us? And it's usually some form of, oh, I heard you on this podcast and I listened to your podcast and then I became an investor. Or I saw a Facebook ad, watched a webinar, listened to the podcast, became an investor. Got an introduction from someone who's a podcast listener, started listening to the podcast, became an investor. So now the intermediate step for nearly, I would say 80% of our investors that have been coming in over the past couple of years is our podcast. And so I view my podcast as I'm showing up in your, Spotify, in your Apple, in your email 2 times a week now with some kind of valuable content that's valuable for a passive investor. And I'm top of mind. So if you don't have the cash right now, that's okay. When you do have the cash, I'm going to be the first person you think of. And so I had a guy just the other day. He's business owner, second generation business owner in manufacturing. And they're looking at selling their business. He's only ever reinvested back into the business. He's probably going to clear between $50 and $70 million. And he's thinking about, how do I turn this into an investment portfolio? Because he's never done any of this stuff before. He found our podcast like literally 2 years ago, has listened to every single episode. He's about to sell this year. He lives, I think, in Ohio. He's like, hey, Ben, can I come out and meet your guys' team? I want to talk about deploying capital with you. And then I found all this stuff when he came out to our office, and he drove all the way out to Kansas City just to meet us and to talk through it. Like, what does it look like to invest with you guys? And it's just because of the podcast. We're providing education. And it took him 2 years, but that's going to pay off pretty big time, right? For somebody that is we're the only people he's really wants to work with, because he feels like he trusts us. He feels like he knows our investment themes. He knows kind of how we operate, how we look at the world, and he, likes it. So we also do webinars. They're kind of more, every month, every 2 months, some kind of educational webinar that tries to pull people in. We use that to market to net new, but also to push people on our lists, further down the funnel. So those are kind of our 2 primary mechanisms.
Yeah, no, it's a really good point too. Just because someone who, especially because the podcast has been going on for how long now?
About 2.5 years.
So someone can likely go on there and listen to, 200 episodes of you talking really quickly, right? So if they want to go all in and really get a feel for who you are as a person, I think that's huge, right? Because what will happen is either they'll like it and keep listening, or say, hey, this group isn't for me, which is fine too.
Totally.
Right? So it'll save your team some time too, versus them coming in, talking to you guys, putting all your resource against it. It'll give people clarity as, do I want to go further, or do I want to opt out here? And either is fine. I think another big point too there is that this person coming to you now with a potentially meaningful amount of capital, by offering different types of deals that you all do, you can probably go build a more balanced portfolio for that person more easily than someone who may only do one certain kind of deal. So this is again why either partnering on different asset classes or having optionality of offering different asset classes and structures is huge, especially in situations like this, to be able to go help that person form a portfolio, but still have control over all of it.
100%. Yeah, we're to your point earlier, if someone's saying, I'm going to allocate, 30 to 50% of my portfolio into alternative investments, right? Whether it's real estate or businesses or whatever. If you only got a one-trick pony, you're only going to get a small portion of that. But if you got multiple things that hit different parts of the portfolio need, all of a sudden you can get 2, 3, 4, 5x more from the same investor in allocating to different things. So it's the easiest money to raise because it's the hardest point to get somebody to that level of trust, right? That's the hardest part. Is someone hears about you online on a Facebook ad, they watch a webinar, they get on a call, and they're about to write you $100,000 check, right? That when I first started doing a lot of digital marketing, I'm like, this is crazy that people actually do this. I mean, this is nuts. But once someone gets to that point and they've already made the decision internally that you're a person to trust, now it's the easiest money you'll ever raise is from someone that already has made that decision. It's so much easier to do that than to go try and get 5 more people at that same point than it is to get 5 times more from that same person who just is going to allocate into different things. And you're actually providing them a service, and you're getting a 5x return on all the work you just did to generate that trust.
Yeah. Yeah. So kind of shifting gears as well. I know I talk to capital raisers and kind of capital allocators really frequently each day. And a big thing people think about is, hey, I'm going to go to these conferences and find LP investors, right? What's your take on conferences specific to the industry that you're in, right? So kind of give us how, you and your team use them, your points of view on them. I think it'd be helpful for people to hear from yourself as well.
Yeah. Well, my approach to conferences has definitely shifted over time. When we first started getting in, when I was just trying to figure out, how to raise money, we go to conferences, we get a booth, we kind of do the rigmarole, try and get some little, tchotchke stuff and some candy and get people to come to the table and try and pitch them on what we're doing. And it was just, you spend a lot of money, a lot of travel, a lot of time, and you're just kind of one of many potential options for people, right? So it's a low pull through rate usually. And then I remember one of the first times that one of our partners spoke on stage, and nothing else changed. We had the same booth, same tchotchkes. And after he spoke, there was literally a stampede to our booth. I was like, holy cow, this is the way you got to do it, right? And it goes back to that push versus pull, right? And so as an authority, humans were predisposed to have a higher trust in authority, right? You think about if someone tells you to do something, they have a white coat on and you're in a doctor's office, you're going to do whatever they say, right? We just have a natural predisposition to just believe someone that we view as being an expert. And someone that in the medical field is a great example of that. The same thing goes for anyone that's on stage, right? If you are at a conference, you see one on stage, your automatic thought is this person has to be somewhat legit to be on stage. And so it creates this elevated place in people's minds that naturally attracts people to you. And so once I saw that, I was like, okay, we're rewriting the script on conferences. We're not going to a conference unless we have a speaking spot. And that's kind of been my approach ever since, because it's not even like somewhat better if you're speaking at a conference and versus not. Like it's 10 or 15 times better pull through from an investment standpoint and just a credibility standpoint, because it's a lot of travel. It's a lot of time. We're all busy, right? And it's not worth it in my mind to go and just try and go hunt the grounds in the lobby area or, people in the main gathering areas. It's just too much to luck that you run into the right person, and you have no reason, no real value that you're kind of coming with from, the first conversation if people don't know who you are. So it's hard to build that credibility in a meaningful way at scale. So stages are the best way to do it. And I leverage that to a lot of different things, because stages aren't just in person. Now those are very powerful, especially if you're in a big room with the right audience, but we've leveraged this across the board to where we're on virtual stages all the time. I'm speaking on 2 to 3 podcasts a week that aren't my podcast, just trying to continue to build audience and doing webinars, doing these presentations. I mean, we're trying to do 3 to 5 some type of virtual presentation per week. And it's those activities that are just doing it so I can just be everywhere. But being on stages, being the one that's talking, that people have come to hear about some topic that you're an expert in, that's the way you create that pull.
Yeah, no, it's hugely important. And I think people at times just go to these conferences thinking they're going to be somebody go solve all their issues. I think conferences can be great when looking at the educational side of it, but ensuring you're set up properly, ensuring the conference actually with the outcome that you want. Like if you're going to a conference, you're a real estate investor looking for LP capital, don't go to a real estate conference for the LP capital if you're looking for, retail investors. People doing those same deals, like they are going to keep their money for their own deals more often than not. But on your end, kind of what advice do you have for someone looking to break into the world of capital raising, whether they are a lead sponsor or more so in the fund manager type role?
Yeah, I mean, if you're just kind of looking to break into it, the first question you got to decide is, do I want to be on the operational side of a business or do I want to be on the capital side, right? And those don't have to be mutually exclusive. I think, you're kind of a unicorn in that, maybe we're a little bit of a unicorn in that, but it's usually pick one or the other, right? Or in your case, you're partnered with some really good operators and a really good team, and you don't have to be as involved in operation stuff. You can really be that kind of face of it to go raise the money. That's a great approach too. So it's really, what are your skill sets going to be best suited for? Because operating deals is a hell of a lot of work, right? So it's really hard to do everything. And that's why a lot of sponsors aren't good at capital raising, because they're actually good operators, right? And that's a good thing. And so there's kind of that first soul searching question you have to answer. And it might not be obvious or apparent right out the gate. Maybe it is, but I think, trying to figure that out. And then the next thing would be, do I want to go in-house with an operator and help them, scale and grow? Or do I want to be an independent capital raiser and have multiple options to provide to investors and build my own platform and generate my own leads? And if that's the route, then Sam's got to talk to.
Yeah, and we're definitely lucky to have Ben too as a coach in our fully funded program too. So if you're looking at capital raising, access to people like Ben as well. But we're kind of thinking of, as we wrap up here, how and why should the audience reach out to you or your team over at Aspen Funds?
Yeah, like we were talking about earlier, we work with a lot of fund managers. So if you're looking to kind of break in and, usually we like to work with people that have done a couple deals, just because, we're trying to hit certain minimums on our deals. But we'll work with people that we feel have a big network, that are able to kind of activate it and, have some level of kind of tertiary or tangential type of experience in this. And, our goal is to work with people long term. So, we work with about a dozen fund managers right now. We're looking to double that this year, and just to build good long-term relationships that if you're winning long-term, we're winning long-term, and it goes both ways. So yeah, that's probably the best place to, if you're at that place, to reach out to us. And also, if you want to learn how we're doing the content piece, check out our podcast, Invest Like a Billionaire, and our website, aspenfunds.us, to kind of see what we're working on.
Cool. Ben, thanks again for coming on. But yeah, I've had nothing but positive experiences, both you and the full team over at Aspen myself.
Awesome. Thanks, Sam.
Cool. Yeah, you bet. All right, Ben.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow, share with your investing pals, and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.